60% of economists predicted a recession this year as well. So 60% are wrong even on that basis. They underestimate how much Australians love property. They underestimate how the government somehow wants it to keep going. Transaction volumes for the office market are down 77% Australia-wide from 2022 to 2023.
So how much impact has rising interest rates had on commercial markets in 23?
Pretty big impact on those yield decompressions. Like, as I said, the office market's gone back 14.4% and industrial 17%. The reason industrial suffered the most, it was the lowest yielding asset class.
G'day, how you going? It's Phil Tarrant here. I'm co-host of Inside Commercial Property with Scott O'Neill from Rethink Investing. It's the Scott O'Neill show. It's what people are telling me these days. Whenever I jump on the social media and see snippets from this, there's always Scott. They never include me on it, thankfully. So I'm happy to report that my knowledge of commercial property is nowhere near that of Scott's. My job is to try and navigate and dissect the issues, the concerns, the markets, the people, the opportunities shaping commercial property in Australia, commercial property investment in Australia, particularly those aspects of commercial property which isn't the sort of stuff that your superannuation fund is investing in. I've been doing a lot of work on this recently, looking at the financial services sector in Australia, and it's a pretty big sector. The amount of money that sits inside of superannuation is huge. Contributions, employee-led contributions into superannuation continues to grow and evolve, and it keeps going up by 0.5% every single year until I think it gets to about 12%. So there's still a lot of contributions coming in, and all that money gets pulled into superannuation funds, and superannuation funds like investing in commercial assets is what they do, whether it's building new stuff or investing in existing stuff. So that's not really the commercial property we chat about on this particular podcast. What we talk about is the commercial property that non-institutional investors invest in. Price points from sub $1 million to maybe $20-30 million is where the cohort of investors choose to channel their dough when it comes to this podcast, and that's pretty much Scott O'Neill or Rethink Investing's client base. Fair assessment, Scott?
Yeah, except for the underdog card you always play. I think you've been good this year, mate. You have more property conversations than anyone in the country, and you've carried this podcast. So
I've carried it, have I? I'll say you're carrying it. It's funny you say that. You probably have more property conversations, and I've probably had more property conversations that are recorded than most people or anyone else in Australia.
Offline with property, or you
a little bit. I would say that buyers agents and property strategists have a lot more property conversations because they do it every single day. The 95% of the property conversations I have are recorded on this podcast. The challenge that I have, it's not a bad challenge, by the way, is that because I do this show with you, people think that I actually know a lot more about commercial property than what I do. So if I'm out and about, people want to talk to me about commercial property, and I just sort of shrug my shoulders and go, listen to the podcast, right? Like, it's all there, and they'll ask my advice and opinion on stuff, and I just go, I can't give you my advice on where you should be investing in property. That's not what I do for a living, and I'm not qualified to do that. So I say, go and speak to Rethink Investing. They'll help you out. He'll charge you for it, or anyone who's going to give you advice in this regards will charge you for it. But my recommendation would be, if you're serious about investing, whether it's commercial, resi, or whatever, pay the right professionals to help you make the right decision. You can do it all yourself. It's cool. A lot of people do that. I don't have the time, bandwidth, inclination to do it myself. But if you want good advice, you've got to expect to pay for it. And, your fees aren't cheap by any means compared to what? When you think of the upside that you get, no doubt you probably have those conversations with investors all the time going, I've got to pay that much for you to find me a property. You go, well, go do it yourself if you want. Yeah. From what I understand at the moment, there's not a lot of commercial stock around.
No, you're right. And interesting point you make. Like in the early days, I remember justifying the fee was a lot more like it was part of the whole sales pitch. We really had to kind of sell it. But the buyer's agent space, since I started like 9-10 years ago, it's changed so much. Everyone's aware of it. It's like you use a selling agent to sell a property. You use a buyer's agent to get access to off-market deals or do the legwork or just open your eyes to a different asset class. So I guess we don't really feel like we need to justify the fee. Like the clients don't ever pin us for it. There's obviously a whole bunch that will never reach out because they don't want to deal with us. But Yeah, I think people are open to paying for services now, and yeah, no, it's just like having a property personal assistant. They do the legwork. It's going to cost you, circa 2% on a deal, but if they save you more than that, or stop you making a bad deal, then 2% is negligible.
Yeah, you don't even notice it if you find the right property, and yeah, you get the upside benefits of it. And what is commercial property about? Is it about finding assets that are going to grow in value? Is it finding assets going to give you good cash flow, or is it finding an asset that give you both? And I think that's one of the things that we've hopefully dispelled for property investors, and maybe why you're getting more people into commercial property investment. This is episode 44. When we started this series of conversations, it was pretty much trying to break down these myths that commercial property is good for cash flow and yield, not so good for capital growth. And I think hopefully we've changed the paradigm on that.
Yeah, no, look, the myth is definitely broken. Like we mentioned in those books, they follow similar growth rates to residential. Like, a lot of people don't realise that a lot of the growth is attached to development costs, land pricing, just local supply-demand ratios. And when you sort of look at it, they're the same things that drive residential. There's obviously owner-occupiers in commercial. They grow very well, and there's a large capital cost to build these things. And if you're sitting in tightly held land areas, the land appreciates, and there's just different growth drivers. And obviously, no one really quantified that too well before, but that's obviously what we commissioned some studies into that to look at square meter rates of building, and we did it by looking at comparable buildings 20, 30 years ago, and then looked at comparable buildings to now. And sometimes it was the same building that's been bought and sold a few times. So you could really quantify the exact square meter rate, and then you just do some compound growth calculations on it, and there you get your net annual rental growth or property growth, rather.
Yeah, and commercial real estate sort of grows differently, greenfield sites to resi, and most good town planners now will include some sort of industrial base or commercial precinct as part of any town plan. I think it might be shops, it might be offices, it might be industrial. But, your view on this, you only need to think of, for example, go and find the most up-to-date or a live satellite image of the freeway from Sydney to Newcastle, and you'll find at every single major intersectional interchange, there's huge developments taking place on it. And you only need to think of interchanges like Tuggerah and Morisset heading up the coast to Newcastle. So do that drive a fair bit. There's stuff popping up everywhere, like greenfield commercial sites are happening all over the joint. Is this how you think you're going to see commercial property grow into the future? Is all going to be sort of linked with these arterial sort of roads and I guess the urban sprawl? Is that pretty much the story for commercial property moving forward?
It's one of them. Obviously, there's going to be outliers. Like, you think of the service centres in the middle of nowhere, but they got that road traffic. So you got things like foot traffic, road traffic. That influences how much rent a tenant will pay because their business is going to do better in those locations. So there is a lot more complex factors. Again, build costs. A developer won't build and then lease to a tenant unless they're getting enough rent. So then the rent obviously dictates the price as well. So it all kind of washes into itself. And the local supply-demand ratio from the tenants is super important. And like we'll go into later in this podcast, talking about the different asset classes, they're all got different growth drivers ahead or potential storms ahead as well. So you need to kind of understand where business is going because that will greatly affect the rental growth.
Yeah, and commercial property is the story of business in Australia, which is intrinsically connected with the economy. So there's lots of factors that shape the direction of commercial property. But let's have a look at 2023. It is December 2023. So we get to sort of do a bit of a roundup of what's sort of taken place, what's happened for commercial property in Australia. How would you define 2023 if you had to give it in a sentence or less, 2023 versus 2022 or 2021, what would it be?
Surprising. That's just the one word. It was...
Surprising in a good way or a bad way?
In a good way.
Okay.
And let's take a backward step. I did a bit of Googling this morning of some of the articles that were coming out late 2022, early 2023, the whole what's happening with the market price predictions. And looking at some of them, like the Reserve Bank of Australia said 20% drop in the next couple of years. The CommBank said 15% falls. this year.
Resi.
This is Resi. And Westpac was 16%. We had others like PropTrack saying they're going to fall 11%. Investment bank Jarden said 20 to 25% crash in 2023. And they all predicted less interest rate rises too. Most were kind of peaking at like 3.1. Remember all those numbers, 3.35. Now look at it, it's 4.35%. So you could imagine that if these guys knew that the rate was going to go up to 4.35, they would have said 30% crashes. But it defied that. The official figures, this is up to November 30, so they've only come out 12 days ago. So the annual growth rate of Sydney, 10.2%. Melbourne, 3%. Brisbane, 10.7%. Adelaide, 7.6%. Perth, 13.5%. That was the top one. And Hobart, negative 3%. Darwin, poor old Darwin, they've had a pretty rough 10 years there, to negative 1.5%. And Canberra's basically flat at negative 0.3%. So that's about 30% off the average prediction. So that's why it's surprising. And that was off the back of record migrations, the amount of interest rate kind of just pumped the rental market up, cut supply. So just fascinating figures. And
yeah, it is. And you sit there just thinking, how are you supposed to make a decision? Like, you get all the information in the world. Your job as a property investor or someone who helps property investors is to interpret that to support decision making. And then excuse me, banks coming out saying property's going to drop by 10+%, and investment banks coming out, which is sort of sitting there and thinking, what are they up to? 20+%. You go, why would they say that if they didn't believe it? Or do they actually don't believe it and they're doing that for some other purpose? Now, it depends whether or not you're a suspicious journalist, how you choose to frame that. But how can the banks get it that wrong? Because I remember when we started this podcast, which was in the depths of COVID, we were told by the banks to expect property prices to fall by 40%, 30 to 40%, if you remember that. So they got that completely wrong. Yep. Completely wrong. And then they come out again and they get these predictions and they get it completely wrong.
Well, interestingly, statistically, 60% of economists predicted a recession this year as well. So 60% are wrong even on that basis. So, look, I don't think there's anything, crazy going on.
Nothing untowards?
No. But look, my sort of take on it as an everyday investor is they underestimate how much Australians love property. They underestimate how the government somehow wants it to keep going for the greater good, remember? Like, you want investors to buy properties. You want, like the migration levels, it's for a reason, to protect the economy. Like we're actually in a per capita recession right now. We're going back 0.2% if you took those 560-odd thousand people out of the country that came here, which is Canberra or, Gold Coast. It's a pretty big area. So, I just think they underestimate the fact that levers change for property, and it's kind of happened forever. And look, there'll be levers that go the other way as well, but the economists can't predict this and they can't factor it in. They're just assuming, the current behaviour will change, and then if there's this variable introduced into the equation, that's going to have that effect. It's not linear decisions like that.
No, and the government changes the rules or the goalposts all the time. And I think what we should do, Scott, for our first podcast of 2024 is actually get an economist in to let's pull this apart and break it down. But we only saw this month, the government coming out saying, we need to curb migration because that's the reason why we have a housing supply problem, right? You go, okay, sure, well, let's not get into that at the moment. But economists are sitting there trying to make their forecast based on information they know now. They don't know what's happening. Now, you see a lot of people do this with their portfolio. They go, my portfolio is performing like this, but if this didn't happen, this is what it would be. We just go, well, it doesn't matter. Like saying, we'd be in a technical recession if we didn't have migration, therefore the country's going backwards. But it's not, because we had 500,000 people come into Australia. So it's nice to say this would have happened if that didn't happen, but it did happen. So what do you do about it, right? And this is what economic forecasters and economists need to deal with. You can sit there and muse about the world and what could have, should have been. I look at my own portfolio and go, well, if it wasn't all sitting in trusts because I need trust structures and therefore I pay a huge amount of land tax. This is the performance by property portfolio. But guess what? That sits in trust structures. So it's a cost of doing business. Yeah, people get caught up with all the what ifs and their say. And by the way, you're not an everyday investor. Because sitting there go, like an everyday investor. You were once upon a time an everyday investor, but you're a very everyday investor that's done well.
Yeah, but look, I was bought into those negative articles. Like my first property, I had the fear of God through me, thinking I'm going to lose my whole wealth because the 40% drops were coming out in 2010 and 2011, because the GFC was wreaking havoc in the US. So, naturally you think it's going to happen similar.
What's his name? Harry Dent? Is that his name? He was the 40%.
Yeah.
He's been saying for 20 years that's going to be 40% drop. Probably. You know what? And when property drops by 40%, he's going to go, I told you so.
Yeah.
But is it? This is it. We've had a huge seismic challenge, which was COVID. That didn't happen. Then you've got these articles we're talking about, wrapping up 2023, the start of the year and late part of last year, pretty much going, forecast again. But the growth that we've had is pretty much taken us back to where we started that price decline from. So sort of where the peaks were sort of like 2021, maybe, it dropped down, come back up. So we're back to square.
That's right. And I'll read some stats out for the commercial because similar things have happened. So, remember, there's three main asset classes. So, I've gone through all the different reports. And remember, this is high level. These are your investment grade assets because that's where the good reporting.
Where the super funds are investing, as I mentioned.
So generally they have lower yields because they buy and sell off each other. They do play the incentive game a little bit more behind the scenes, but that's another story. But there are some interesting things that came out of 2023. So number one, yields increased. So let's look at the office market. Quarter three, 2022, the average yield was 5.21%, believe it or not. And it's now up to 5.96. That represents a 14.4% drop on the yield, assuming the rent's the same. So fairly significant. And rents have been, they say they've gone up 3%. Statistically, that's what they've gone up. So prices have dropped about 11% in that case. But, I get there is an interesting stat that 56% of corporations have now adopted flexible work arrangements for the long term. That number is trending down as well. There are more corps coming in to say, come back into the office for productivity and all that stuff. But essentially the office market has structural problems where the vacancy rates are sitting at 14.2% nationwide. It was 14.1% 12 months ago. So not by much, but still it's been that high for that long. They're horrible numbers. And this is why I wouldn't go into the CBD office market. I've said it a million times. Vacancy rates of that magnitude mean one thing to me as an investor, very little chance for rent growth because your tenants have choice. They've got great choice. They can go and look at 20 options in a day if they want. You won't have that luxury in other asset classes. So to me, there is a prolonged low growth coming up for office. But yeah, we'll stick to 2023 for now. But yeah, it's been a bad year for office, and it doesn't look like it's changing in the short term because the numbers are fairly consistent. Even from 12 months ago, not much has changed.
So just on office market then, at 14+% vacancy rates, there's needs to be a considerable amount of growth to absorb the spare capacity there. But they're still building places. Like we're recording here in North Sydney. I don't know if anyone's had a look at North Sydney recently, with the new Victoria Cross train station. They're building more offices than you've had hot dinners. They're just contributing to wider vacancy. So I sit there just going, okay, is that just going to sit vacant for 10 years while we sit around and wait? Or is it going to be like waiting for Godot, right? It never happens. I don't know. Thoughts?
Oh, look, they simply poach tenants from older buildings. So the flight to quality is a word they use in this industry a lot. There is a flight to quality. And if they give them a nice fat incentive, like 40% of their rent off, it's going to be tempting to move. So you'll find the older buildings sit dormant and vacant and will become redundant.
And they'll just turn a bit of resi properties.
Something like that, or they knock them over and build again, which, again, surprisingly happens. I'd love to see the feasibility study on, one of these $300 million towers, how you've got to pay that much for the land, knock it over, redeploy it, then you've got to pay for all the tenant incentives to get them in and then you're still sitting at a fairly low yield. But it must work.
Well, this is well, maybe it works because going back to superannuation, you've seen them all sort of clubbing up around trying to remove sort of benchmark performance indexes around, they're deploying Australians' retirement savings into sometimes these investments, which you would sit there thinking, why would the big super funds be pumping their money into something like that, buying something for $300 million, knocking it down, rebuilding it, and I'm talking about office tower, something that's going to sit half vacant for 10 years. Like, you sit there and just go, where's the dough? Yeah. Like, who's making money out of that?
Well, a lot of people aren't at the moment, and that's reflected in the fact that transaction volumes for the office market are down 77% Australia-wide from 2022 to 2023. So think about that number for a second. That's huge. That is basically caused from a disparity between what sellers' book values are. So let's say they need 100 million for a tower. They're generally they're lucky to get 80 million for that. So there's a 20% variation between real values and book values. So
yeah, we probably need to pull that. We've sort of spoken about it in the past, but this is so there'll be a lot of these large towers that have a book value and a real value. Book value, a lot of these are leveraged as well, so there'll be finance connected with it. So it needs to be worth this much. So 100 million, when really, if you sold, it's only worth 80. There's huge negative equity in these things, right? But they buoy up the book value through having tenants in there paying a face rent of $600-700 a square metre, but there's an incentive deed tucked away in the back of it, which is probably turning their actual rent to $250 a square metre. That's not really the case, but this is how it works, right? And commercial markets for office space for 23, it's obviously challenging. We'll have a chat about what you think it is for 2024. How have the other markets gone in 2022 for industrial? So I guess industrial, retail, and I guess specialty.
Yep. So industrial, the average yield in 2022 was 4.6%, so lower. And it's lower for one reason. It's viewed as the safest asset class right now. It's sharper than any other asset class right now because there is a lot of rental growth. So that has expanded to 5.37% in 2023, which represents a 16% drop if the rent was the same. In the last 12 months, though, rent has grown officially as of today 17%. So pretty significant numbers, and that's coming off the back of a 23% the year before. We're talking strong double-digit growth rates, and it's still got momentum. The vacancy rates went from 0.6% in 2022 to 0.8%. So could you get two different asset classes? No. That is tighter than any developed world country at the moment. So the fact that build costs have gone up, it's harder to replace the values of these properties existing. So it's a really good story for rent growth. I'm quite bullish on the industrial market, as most people are in this industry. We see that there will be more demand, especially when rates eventually drop. That'll be kind of one of the collectors of the large pool of money sitting on the sidelines. But we've seen volumes drop 38% as well. Not as significant because you still can find buyers to pay the right amount, and at least there's upside in it. So me as an investor, I'm not thinking about the last 5 years. I'm thinking about the next 5, 10, 20 years. And industrial is one of those markets where I can see the rent is surging, the cost of building still high. You're buying large freehold assets in good areas. It just makes sense. You'd like to park your money up in that asset class, and it's not a dropping tide the previous asset class we mentioned.
What about retail?
Retail's gone from 5.7% net yields in 2022 to 5.9%, so the most stable, and vacancy rates are 6.2% and 6.2%. So retail...
So by the way, the numbers you're banning around is irrelevant whether or not there's debt or not against the asset. This is just face numbers, right? This is not about sort of performance, how it would be for you, for individual investor.
Yeah, that's right. And look, talking about debt, different sources have different numbers, but they kind of all spit out somewhere around 30% debt levels. So it's a fairly low debt world, this. So that's why the face yields are quite low in these asset classes. And when I'm talking these yields in the mum and dad region, so you call it the sub 25 mil mark, yields are better. We have some exceptions. Some of the retail centres go for very high yields, but there's more incentives again parked up into those major tenant profiles. But retail's been a strong performer this year. Retail spending growth is still up as of September, 5.2% annually. So people are still visiting the supermarket. Medical falls into this category too. Then you've got your fast foods and your neighbourhood shopping centres, all that stuff. So it's kind of the most stable asset class. It hasn't had the yield decompression as the others. It doesn't have the vacancy rates of the office world, but it also has a better yield than industrial. So it's kind of like it's not an in between one, but it's just a good stable asset class, which varies greatly in practicality because there's so many different types of retail.
So how much impact has rising interest rates had on commercial markets in 23?
It's had a pretty big impact on those yield decompressions. Like, as I said, the office market's gone back 14.4% and industrial 17%. The reason industrial suffered the most, it was the lowest yielding asset class. So whenever interest rates go up, you're going to find the lower yielding assets impacted the most because it makes no sense to lend into them. The high yielding markets, and that's what Rethink targets, like we buy a lot in Brisbane, Perth, Adelaide, major regional centres, we're minimum 6.5% yield. So, we've actually seen those markets completely stable on the yield in most areas. And so there's no yield decompression, maybe a little bit. Like I actually did a big spreadsheet where we added up, about 1,000 of the deals we presented to clients and from 2022 to 2023, and we had a 0.45% yield expansion. So, let's say it was a 0.6% yield. The average back then, now we're showing 6.45. So not a great difference in the yields, but and that's reflected of the different yield starting points. So effectively, it's still attractive to investors, especially when you start thinking long-term that, yes, interest rates will drop, we hope. Yes, there's nowhere better to get a 6% yield with growth on top. And again, if you're leveraging the money, it's still positively geared if you've got a cash deposit.
Yeah, and cash deposits typically need to go into commercial properties, even though with some lending requirements these days, there's some lenders doing 103+% of assets now, right? As long as you can stump the money to pay the stamp duty, you're in.
Yeah, and like when you do those 100% loans, you don't go for a 6% asset. You go for a 7.5%, 8%. So there might be a little bit more risk attached to that, might be more regional, might be an older building. Whatever it is, you've got to then kind of align your strategy with your situation. But I've got a lot of clients with 50% deposits. They just want the best quality asset they can possibly get, whether it's capital city or major regional centre. And they're going to get the upside and growth on it. So, a couple of years' time, they're still massively positively geared. It doesn't really matter if they're getting an extra 10 or 20 grand cash flow. They're there for the good asset.
And that's why you should be thinking about 10, 20 years in the future. Who's walking around with 50% cash deposits on multi-million-dollar assets? Is it just the people you walk past the street every day and you just don't know they've got heaps of dough in the bank?
A lot of doctors, a lot of dentists, a lot of business owners, random guys with businesses in manufacturing. It's quite fascinating. I love my job being able to talk to these guys. Like, a lot of entrepreneur types that have set up, online gambling casinos and stuff like that. Like there's literally guys that will come up and say, I've got to buy every quarter because they're just cycling their money from their business to property because it's protecting their wealth. So there's a lot of these guys out there, not relatively, but there is people doing well in this economy, and it's your tech type businesses that have flown. And
so this is the old adage of make your money in business and park it in property, and I guess it should be make your money in business and park it in commercial property. So there is money washing around. Like, are they the people you're most like working with who've got big cash deposits and they need to deploy it and they've got plenty of it and they just don't really or do they ask a lot of questions? Are they hard to work with?
No, look, I find they've got a lot of business acumen. So the more knowledge a client has, the better it is. My hardest client is someone who doesn't know what they want. They might have a bit of money, but they haven't really considered commercial. They may have just seen one of our ads online or something like that, just enough for them to reach out, but they haven't listened to the commercial show. They haven't done read books or anything. They're the hard ones because it's just all unknown for them. And I show them an industrial asset in, Adelaide, and they're like, what's this? This is the cash flow, and it's a whole education process. They don't understand what's happening with the rent growth. They don't get that vacancy rates are not terminal problems. Like But yeah, the more educated ones are the best. And anyone that listens to this podcast, and we've worked with hundreds, of probably thousands to be honest now in the years, great clients to work with because they get it and they've got their own opinion.
So essentially, you're doing all the heavy lifting here, recording this podcast to educate people so they can get a better outcome. And it's, I guess, speed to purchase, the smoothness of the purchase or the ease of the purchase, and then probably the quality of the purchase is better if people come in educated. So, So you're saying you're not going to listen to anyone unless they've listened to you're not going to work with anyone unless they've listened to all now 44 episodes of Inside Commercial Property.
No, it'd take a long time to catch up. But believe it or not, people do that because they've just come onto the podcast and then they binge it, which is interesting because it's all time stamped. So we would have been saying totally different things 3 years ago and comparing it to now. And, it's relatively checked out, to a degree. It's always interesting when you put predictions into the market, but we've always been quite level with things. We're not talking extreme growth. We're not talking about extreme crashes. This year's is a perfect example. Even with everything that's happened, I was quite, confident at the start of the year that demand would remain quite solid because we're in a low stock environment. If you knock out 30% of the buyers, who cares? There's still the other 60, 70%.
So there's
plus.
more buyers than sellers.
It's always been our problem, there is a lot of people on the sidelines right now. So, going into predictions, whenever that third of the market comes back in, that's when you'll see the boom type conditions. As long as supply doesn't just somehow double overnight.
Yeah. But putting that into context, and I've asked you this question a couple of times over the year, and I guess sort of recapping 2023, I don't yet know if I'm satisfied with the answer. So I'm going to ask you again, right? When we started this podcast, when educating people around property, interest rates were a lot lower than what they were. So the yields, as in positive cash flow from your investment, if you were investing at 30% deposit, so 70% debt, was pretty good. Money in your back pocket. Not so good today. And even at 30% deposit, 70% debt, most commercial properties are probably teetering on positive cash flow. Yep. So why would you invest in commercial property today if you're not getting the upside or the uplift of money in your back pocket? How long are you going to have to wait until that fixes itself again so we improve the cash flow or the yield side of commercial investment?
Well, I think you've got to simplify it. You're trying to get a return on your money. So one thing we did again in the book, talking about those growth rates, is we compared the net returns of both residential and commercial and the net growth. So over the last 20 years, average growth rates of commercial were around 6%, and then add about 5.5%, 6% net yield. So you're looking at about 11.5% overall return. Residential, you're getting about 7%, and add a couple of percent because that's all you're going to get for the net yields. You're looking at sort of about 8.5%, 9%. So you are clearing the total returns at least 2% per annum, sometimes 3%, over the long term. So you do make more money in this space. That doesn't account for leverage. It doesn't account for maintenance because that would actually chip away from the residential numbers further because obviously commercial tenants will pay for it. But overall, you make more money. There's this mindset that you're going to have to get it all from cash flow. It's still 3 times better than residential. But again, I'm a big believer of residential. I'm not here to say don't do it. I'm very adamant. You need to start in residential. This is the space where it's lower risk. You can learn how to invest. It's like I'm a big believer you should invest in stocks too. Put $1,000 and lose money. See, you got to feel it. You got to go through that pain, and it all makes you a better investor. But if you went full hog into commercial without having any investment psyche behind you, it would probably be a bad day unless you get someone to help you, and obviously that's a different story. But even then, you need to be conditioned to be able to get through your first vacancy or your first large maintenance request. It's not all smooth. So residential has its place, but to answer your question direct, it's still a lot better cash flow. If you're answering that same question in relation to your residential portfolio, instead of breaking even, you're probably horribly negatively geared. So that's the choice.
Yeah, and depends how much sort of spare cash you got around to service a resi portfolio. But is it okay? And I've seen what you've done there. You've gone, you get this capital growth and this yield as a percentages. So let's add those percentages together and I get this magical number for commercial property. So obviously slightly subdued capital growth compared to resi property, but higher yield, bundle that together, then you get capital growth inside of resi. And I think sort of traditionally it grows by about, 7.25% a year, whatever it is, plus your yield, which is a lot lower, not taking into consideration a lot of it gets eroded by other costs and stuff. So you've glued them together and said commercial is the winner. Yeah. Like, is that Scott O'Neill's methodology, or is that a standard way to be looking at it? I know you're proving a point, and I'm not going to contest it, but is it okay to do that?
Well, it's the only way to do it. You got to look at total return. You don't ignore half the equation, and that's sort of what residential do when they quote gross returns. That kind of baffles me still. Like, I saw someone advertising, I got a 9% gross return house, but it was a strata complex 1-bedroom unit in Cairns. The outgoings would have, halved that yield instantly. So you have to look at the true numbers, and that's net numbers. Growth rate, compound growth rate, and net figures. How much cash flow are you really taking home? Add it together.
But can you say they're both the same? Are you saying that they're both as equal as each other? Is capital growth and gross returns on an equal footing?
Oh, there's different ways it handles from a tax point of view. So you will argue that it's better to get your income, I think, annually, because that helps with servicing. So look, obviously cash flow is different to capital growth. You got to refinance or sell to get access to your capital growth. I think that's less attractive. One of the reasons I left residential as a permanent investor in that space, because to get your money, I had to create more debt or sell an asset, and then you're out of the market, and then you got to get back in and pay taxes, capital gains.
It's a lot expensive to transact. So what you're saying then is it's a good point. It's an important point. Probably one of the most important points of the year is that if you're looking to realise the immediacy of your property investments, commercial will give it to you by way of income. Now, positive income is you need to pay tax on it. So no matter how you slice and dice it, you're going to have to pay the tax man, right? But in commercial property, because a lot of its upside is yield being cash coming in and positive cash flow, means you can access that money without having to do anything structural. You've got to pay tax on it, but you can actually pull it out and use it. Whereas resi, you might get higher capital growth, but that doesn't mean anything. It's a paper profit. You can only realise that money by refinancing it, which means you've got more debt, and yes, you're going to get some dough out, but you've increased the cost to hold the property, or you sell it, which means you're going to have to pay capital gains, et cetera, et cetera. So there's a lot more liquidity for people in commercial property, and that is probably a core point.
Yeah, and so they are the same returns, but there's different tax outcomes and different practical outcomes with it. So you would rather the cash flow because it's an instant return that you can use and potentially redeploy. There is also one very important factor called depreciation. You can buy properties. We bought a childcare the other day. The guy was clearing after mortgage about $100,000 income, but there was a $268,000 year one, and it was a brand new asset, year one depreciation allowance. So not only does he pay no tax on that $100K, there's potentially another $168,000 he can offset other tax potentially. So they make big differences in the outcome. But yeah, the liquidity is a big problem in terms of real life. Can I retire on this asset class? And, unless you're permanently refinancing, which gets very hard when you retire, you have to probably sell, especially the way the banks are going. I'd argue that the income you get from month-to-month income is a lot more valuable than capital growth.
Yeah, if you're looking not to work, which is, you make a good point. You probably need a really good accountant in place. And this is the issue and I've seen it happen beforehand where you get the upside benefits of a really good purchase like that with this depreciation benefit on it. When you submit your financials to the tax man and they go, oh, hang on a second, because you bought that, you've been able to offset 100% of the tax consequence of this property plus offset other taxation stuff. Sometimes it doesn't pass the pub test, right? And it gets really, 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 really hard to orchestrate this appropriately so your tax affairs are in order, and you need a really good accountant when it comes to that sort of stuff. Good problem to have, but a lot of people will buy commercial assets with the tax outcome in mind.
Yeah, it's because you can have the negatively geared benefits of being, or you can be negatively geared but have the benefits of being positively geared. So the best of both worlds. And again, like if you're buying multiple properties in trust, like there's obviously going to be a a true up of all the assets in that and all the depreciation. So, again, that's for your accountant to decide. But the point is you will get greater depreciation benefits because you can claim on potentially fit outs if you own them, the whole building. With residential, it's a lot more restricted.
Yeah. Well, I remember having a chat with, I don't know if you know Brad Beer, he's CEO of BMT. Okay, Brad, I don't know if you tune into this, you might do. I remember chatting to him. Where was he? I can't remember the exact story, but it was at a function when it was, I think it was the budget, some sort of budget function where they outlined the depreciation changes in residential property. He said he fell off his chair, right, where a lot of the upside benefits investing in resi property around depreciation was eroded, where you couldn't, I'm probably going to get this wrong, but the depreciation of existing plant equipment was gone. It had to be brand new, and it was like completely changed. That you can still, and I highly recommend if you have any property at all, make sure you've got a depreciation schedule on, because all properties there's still some element of depreciation. Just lost a big bit of it, right? And can't speak to Brad. I'm sure he'd be happy me saying that. I think he's the biggest depreciation company in Australia. But it changed it. But it's different the rules are different for depreciation in commercial property.
Yeah, effectively you can still claim plant and equipment. That's the difference.
That's the big difference.
It's an extra half. Again, I'm not a depreciation expert.
You're okay with me plugging Brad then? No, sorry.
No, but it's an important point. A depreciation report is vital for commercial property investors because there's likely a better outcome than you would get like for like in residential.
Yeah. Anyway, so this is all the complexity. So 2023, so the wash up is surprising. In a good way.
In a good way, like the property markets for housing did very well by and large, and then the commercial markets had a mixed year. But I think it was more predictable for commercial. If you asked me 12 months ago, I would have definitely said, yeah, cloudy times for office. I knew industrial and rental market was so strong, so there was always a good story there. It was just depending on how much yield decompression there would be, and I was definitely of the opinion, and I've proven because that's sort of what I've purchased personally myself, the retail market would be a lot more steady than people think. And it's proven that. And I think it's going to be more of the same for 2024. Like if I had to predict 2024.
Give me one word for it. It can't be surprising.
I think it's going to be, you've got me on the spot. I think it's going to be a good year. But you got to be really.
It's going to be consistent.
That's probably a better word. Consistent in the fact that we're going to have high mortgage costs most of the year. Like everyone's kind of talking about this rate drop. That's not going to happen, early 2024, maybe at the end. But regardless, the chatter of the rate drop will gain momentum. And remember, people act before the move. Smart investors don't wait for the actual day it happens. They'll be kind of going, yeah, I can feel it's dropping, so let's go. And a lot of people are already going. So the volume of buyers per properties is increasing. Stock will remain tight. We're at horribly low levels, and it's going to remain tight for a couple of reasons. The fund managers are all quiet. There's not many people putting money into funds at the moment to get their 5-6% returns. There's some starting to offer 7%, which is better. But by and large, with higher interest rates, less money flows into syndicates. But that could be an opportunity. You can buy well, and these syndicates are starting to get some very good deals. I've seen some neighbourhood shopping centres in the 100 mil type price point sell at 8% plus. Like that, they're good numbers. So they're buying very well, and we're looking at doing some syndicates ourselves just due to the timing of the market. I think you can buy very well in 2024, and then when the rates drop, let's say it's 2025, that'll be one of the biggest years for property all over, because that third of the market that's sitting on the sidelines will start deploying their capital. Because remember these volumes, like we're, as Australia-wide, we're down 58% in terms of total sold in 2023 versus 22. And remember, 2021 was about twice the size of 2022. So we're like way down in terms of volume. So there's a lot of people that haven't done much for quite a while. So by nature, there's money building on the sidelines that haven't invested, and they'll look for an opportunity to come in. I don't think it'll happen super quick, but yeah, my prediction is 2024 will build up to one of the best markets we'll ever see, and that'll be in 2 years' time if if my gut feels me right.
If you can't, well, you've been often right in the past, and you're a proud author or co-author of a very important book around commercial property, which seems to think that you get it right. But this is sort of just musing, thinking about 2024 and commercial investing. You spoke about sort of funds management, sort of triggered sort of my attention in relation to what will happen with property funds and REITs, real estate investment trusts moving forward. I don't know how up to speed you are on this, but I'll ask the question because if you are, it's giving you a really nice social media snippet. In the background, and I'd like your views on it. Maybe we can get some people in and have a chat around it. The role of financial advice or financial advisors inside of commercial real estate investments. Now, financial advisors will give you recommendations on where to be deploying your super assets, which super funds you should be investing in and why, whether you're self-managed. But in the background has been this thing called the Quality of Advice Review, which was a report commissioned by the government to work out, essentially ask the question, how do we get more financial advice in the hands of more Australians so they can make more informed decisions? And we're not giving, I don't, because I'm a journalist, financial advice many needs. We're just a couple of guys talking about investing in commercial real estate. You would offer advice as a paid service to people that use you. That's all cool. But the idea of getting more advice in the hands of more Australians. Financial advisors traditionally have overlooked direct real estate as an investment. And if people do have a bent towards commercial real estate, it would be through REITs or other mechanisms, maybe syndicated stuff inside of real estate. So this whole idea of quality advice review, what they're talking about is this new sort of breed of advisor called a qualified advisor, and allowing banks and super funds again to give advice. And it's a big deal at the moment. Have you got a read on this yet, whether or not there's any consequence to commercial property investing? Do you think we're going to get more advisors considering commercial property as an investable asset class for Australians?
Look, I think we will, and I've already started seeing it a lot more. And the one problem with the advisors is if they just don't know the asset class enough, because they get pitched by syndicates, and there's some office ones, there's some medical development ones. Like there's a syndicate for any day of the week, really. And
these are just private syndicated stuff.
And then they get obviously kickbacks and stuff like that. So that's where it's a little bit cloudy, and I'm not up to speed with it, but I do see people recommend syndicates. Like as a commercial expert, I would never put $1 into that specific one. But then there's others, and you go, oh, all right, that makes a lot of sense. So the quality variation between syndicates is enormous. It's probably like the stock market to a degree, but rather than getting into a blended, thing of 10 of the top ASX companies, you're dealing with one property, and that kind of is a little bit risky. And especially when you've got a syndicated taking large fees out of it and all that kind of stuff. So again, it's a space that needs more education by the experts as well, or the advisors. And, but it is a good thing. If you can get into the right syndicate, you can do very well. And it's proven. If you look at the results for the last decade, I think they've topped the ASX for most categories in terms of returns because of the great capital growth. And it's a high yield paying stock. So they can be very good. But like we've discussed here, they are going different directions, the asset classes. So you've got to get into the right, even though there's a professional manager managing these schemes, they're going to go very different directions in a hurry.
So how do you go about crafting the best commercial property portfolio in 2024 with a view towards direct investments through your super fund, syndicated, listed or unlisted, syndicated stocks or whatever it is? How do you go about doing it? I'm going to start with this question. Should you be investing in commercial property in 2024?
As long as you can cover the interest rates where they're at on average for the next 12 months. Now, again, like the predictions are so inaccurate. Like again, CommBank thought they were going to max out at 3.1%. Now we're at 4.35. So even the big guys get this way wrong. But with the data out there, most economists are saying we're at peak, or there's one more rate rise to come. And that is a good thing for a purchasing point of view. So you are going to get a good deal. Like I mentioned, that we've seen drops in prices in the order of about 15% at the top end of town. It's a little bit more resilient in the lower end of town, but that is a good buying opportunity. If you could go into any market in history after it's dropped 15%, it's generally a good result as long as it's not a bypass town or a coal mining area that's close to the mine. So I think there'll be really good opportunities to buy well in 2024. The cash flow is not going to be as great. I literally had a chat with a client on the way here, and he was saying, "Oh, it's a marginal deal. I'm making 10 grand out of this. What's the point?" And the point is, in 2025, there'll be drops. The rents are growing at quite strong rates, so the equation will widen. Instead of getting 20, you might be getting 40 by 2025. So you've got to get in while you can. Buy well, weather the interest rate cycle out. So, if you're putting cash into the deal, you're still positively geared. It's easy. If you're doing 100% finance, be a bit more careful. Go for the high yielding assets. So it's probably a question, if you've got the cash, you invest. If you're 100% lending, you need a good quality, high yielding asset to justify the purchase.
Would you be dabbling 100%?
Well, they've always got other assets behind them. So, we had Michael who deals with farmers who've got, $10 million plus farms, and, they've got large incomes coming through. They've got other investments. They've got paid off investments too. So, yes, I would be expanding your asset base in 2024 because there is going to be a ramp up over the next couple of years. You can just feel it. Because money's been on the sideline, it will redeploy eventually when the good news stories comes out on the rates. So you want to be in the market prior to that happening. And if you're lucky enough to have millions of dollars invested in that market while it's quiet and then it starts expanding, that you'll get the upside without even stressing about it. It will come. And it's off the back of higher rent growth and cheaper lending coming.
So asset to credit is key. So how easy it is to get loans or mortgages against commercial property. And I'm already seeing inside of the resi markets these little green shoots of access is getting a little bit easier. There's now these buffers on refinancing, and there's also now buffers on certain lending you can get for new purchases, where rather than getting assessed at a 3% buffer for serviceability, they're down to 1%. A lot of rules and stuff around it. The fact that so it's starting to happen, and this is going to be a key driver that will, I would think, positively shape resi investing moving forward. You've seen the same in commercial. The fact that you can get 100% or 100+% finance against some commercial asset means that there is a growing access to credit in order to empower property investment. That has to be something which will bode well for property investment moving forward in terms of capital growth into 2024.
Yeah, and so 100% agree. It's a game of finance property. So finance is getting easier. It was getting harder this time last year, significantly harder, and yet the market was quite resilient. And I think it's backed up. Again, we spoke at the start about economists getting it wrong, but if you look at the trend this year, what the economists are saying for 2024, I'll just read some of them out. Lewis Christopher is predicting this is nationwide home values in 2024, 6 to 8% growth. Joe Masters at Barrenjoey, 6.6% growth. Shane Oliver, AMP, 7% growth. Narrator from Ray White, 4%. You've got Jarden, they were the guys calling the 25% crash in 2023. That was 6.5%. So look there, and there's a couple of
that's
threes
resi.
and fours. Yep. So resi's looking good, and remember, resi and commercial, they do follow the same suit in terms of the lending environment. They are tied to the finance. There's obviously different growth drivers on the rent side of things and that, but by and large, it's looking a lot more positive in 2024 versus 2023.
So fast forward 12 months and we're getting together in the middle of December thinking about what the Christmas period is going to be like. What are we going to be talking about, Scott?
Next year?
Yeah, this time next year.
I think we're going to be
Give me the themes. Give me 3 themes.
It's going to be all about what's happening with interest rates. The impending drop, and you've got to remember, what's the reason for the drop? Is it a recession? Are we going to be talking about some bad news story? Because it doesn't just drop with sunshines and rainbows. There's going to be something out there that will create the next fear. There's always a fear. There's always a cliff. What was the last one we had this year? The fixed rate cliff. Where is it? Yeah, no one got hurt from it.
Yeah, family balance sheets are so strong, most people have absorbed it.
Yeah, so there is definitely people hurt, but we're talking the majority. The majority is not hurt, and that's reflected in the statistics of the growth this year. It's been so strong, even in places like Sydney, where it's so high price and so low yielding. It grew double digits this year, and that's when lending capacities dropped by 30-40%. So it's amazing what's happened. So there'll be another cliff next year. I look forward to hearing what it is. But there will be
Maybe I can invent one for you, mate. Is that what you want? What do you want it to be?
Start the trend. Yeah, you'll get quoted in every newspaper because look, negativity sells. That's probably the underlying theme that we always deal with investors. That what are we 8th, 10th negative, or as humans or something like that. So we like the negativity, and that will propagate articles. So yeah, I think dropped interest rates, some bad news story roughly around the economy. There will be more foreclosures, but at very low percentages still in the resi market. And you'll find the lower value capital cities do well, I think. So the likes of Brisbane, Perth, Adelaide, potentially Hobart will have a rebound as well. So
all right,
again,
there you go.
gut feel.
Well, we've got 12 episodes next year to work our way through all that, mate. But let's kick off the year with an economist. We'll get that sorted out and get someone in that knows what they're talking about. That comes that sort of stuff. Plenty of them out there. I'm sure we can track one down that can give us an insight to it all. Yes, residential property, but I really want to look at it through the lens of commercial. You don't get a lot of it. It's really undercooked when you get economists talking about commercial property. So I'm sure I'll be able to find one. Enjoy the break, mate. Don't know what you're doing, but I hope it's a good one.
You too.
Not
Thanks.
tuning into podcasts, no doubt.
And thanks everything, Phil. It's been another good year, and thank you for your support through the podcast. So
yeah, mate, I do enjoy it.
mate.
It's just not me. It's a big team here that do all the heavy lifting. I get the good bit of the job, which is chatting to you, but a lot happens behind the scenes. So big shout out to all of them. And if you like what we're doing on this, leave the reviews. So we do get a kick out of seeing it. And if people want to talk to Scott, you guys are still got a week or so before you shut up shop for a little while. What's the best way to reach out to you guys?
Just rethinkinvesting.com.au or Google Rethink. It's there's a few different ways to reach out. If you want to learn about commercial property, we've got Rethink Commercial Education. If you want a loan, talk to the Rethink Financing guys. Or if you want help finding a property, that's the investing crew.
Sounds like a one-stop shop. You do have a legal business as well, right? You missed that one out.
Yeah. No one goes to legal first, though, do they?
Do you know what I saw actually? Just really quickly, one of your team members in your legal business was a finalist for the Women in Law Awards, which is one of our programs. So anyway, it's funny on the legal side that we do. Anyway, congratulations to her. But that's Scott O'Neill. That's Inside Commercial Property. Thanks for tuning in, everyone. Hope you enjoyed it. This is rounding out 2023. We'll be back in 2024 for more commercial property. Until then, we'll see you again next time. Until then, bye-bye.